Today, we're diving deep into a story that shook the world to its core. A story of ambition, risk, and a collapse so massive it triggered the worst financial crisis since the Great Depression. This is the story of the rise and fall of Lehman Brothers. It all started way back in 1844, when Henry Lehman, an immigrant from Germany, opened a small dry goods store in Montgomery, Alabama. Soon his brothers, Emmanuel and Mayer, joined him, and they officially founded Lehman Brothers in 1850. They started as cotton brokers, but their ambition was much bigger than just trading crops. They were smart, they were driven, and they quickly moved into the booming world of finance, relocating their headquarters to the financial capital of the world, New York City. For over a century, Lehman Brothers was a pillar of Wall Street. They survived the Civil War, the Great Depression, two world wars, and countless market panics. They became an investment banking powerhouse, financing railroads, helping companies like Sears and F.W. Woolworth go public, and expanding into everything from trading to asset management. By the early 2000s, Lehman was the fourth largest investment bank in the United States. They were at the top of their game, a symbol of financial success and stability. But beneath this glittering surface, the seeds of their own destruction were being sown. So, what went wrong? The answer lies in the American housing market. In the early 2000s, something called the subprime mortgage market started to explode. These were loans given to people with poor credit history, meaning they were riskier. Traditionally, banks were cautious about these loans. But a new financial product changed everything: the mortgage-backed security, or MBS. Here's how it worked. In simple terms, banks would bundle thousands of these individual mortgages, the good, the bad, and the ugly, into a single package. They would then slice this package into different pieces, called tranches, and sell them to investors like Lehman Brothers. The idea was that by bundling so many mortgages together, the risk would be spread out. Even if a few homeowners defaulted, the majority would keep paying, and the investment would still be profitable. Investment banks like Lehman took this a step further, creating even more complex products called collateralized debt obligations, or CDOs. This seemed like a genius idea at the time. It fueled a massive housing boom, interest rates were low, and it felt like everyone could afford a house. House prices kept going up, and for a while, everyone was making a lot of money. Lehman Brothers dived headfirst into this market. They weren't just selling these securities, they were buying them aggressively for their own portfolio. They also acquired several subprime lenders, getting even more deeply entangled in the housing market. They borrowed massive amounts of money to amplify their bets, a strategy called leverage. For every dollar of their own money, they were borrowing and investing over $30. As long as house prices went up, this was a recipe for incredible profits. But what if they went down? And that's exactly what happened. By 2006 and 2007, the housing bubble, inflated by easy credit and speculation, began to burst. Interest rates rose, and millions of homeowners with subprime mortgages suddenly couldn't afford their payments. Foreclosures skyrocketed. The very foundation of those mortgage-backed securities began to crumble. Suddenly, those safe investments were revealed to be filled with toxic debt. Their value plummeted. Lehman Brothers found itself holding tens of billions of dollars in assets that were now practically worthless. The market for these securities completely froze. No one wanted to buy them at any price. Lehman was stuck. Panic started to spread across Wall Street. Other banks, realizing how exposed Lehman was, stopped lending to them. It was like a bank run, but on an institutional scale. Lehman was running out of cash, and fast. The firm's stock price, which had been flying high for years, began a terrifying freefall. In 2007, their stock was trading at over $80 a share. By September 2008, it was worth less than a cup of coffee. The entire financial world held its breath during one fateful weekend in September 2008. The U.S. government, led by Treasury Secretary Henry Paulson and Fed Chairman Ben Bernanke, scrambled to find a solution. They had just bailed out another struggling firm, Bear Stearns, earlier that year, and they were hesitant to do it again. They tried to broker a deal, hoping another bank like Bank of America or the British bank Barclays would buy Lehman and absorb its losses. But the hole in Lehman's balance sheet was just too big. The toxic assets were too toxic. No one was willing to take on that much risk without government guarantees, and the government, worried about setting a precedent of bailing out every failing company, a concept known as moral hazard, refused to provide the funds. The negotiations collapsed. There were no more lifelines. So, in the early hours of Monday, September 15th, 2008, Lehman Brothers, a 158-year-old institution that had survived almost everything, filed for the largest bankruptcy in U.S. history. The news sent an earthquake through the global financial system. The stock market crashed. Credit markets, the very plumbing of the economy that allows businesses to function, completely seized up. The fall of Lehman proved that no institution was too big to fail. The panic was so severe that just days later, the government was forced to bail out the insurance giant AIG with a staggering $85 billion loan to prevent an even bigger catastrophe. The Lehman bankruptcy wasn't just a Wall Street problem, it became a Main Street crisis. The credit crunch meant businesses couldn't get loans to pay their employees or buy supplies. This led to massive layoffs. Unemployment soared. The global economy plunged into a deep recession, the effects of which are still felt by many today. The collapse exposed the deep flaws in the financial system, a lack of regulation, excessive risk-taking, and complex financial products that almost no one truly understood. In the aftermath, governments around the world passed new regulations, like the Dodd-Frank Act in the U.S., designed to make the financial system safer, increase transparency, and prevent a crisis like this from ever happening again. The story of Lehman Brothers serves as a powerful cautionary tale. It's a reminder of how quickly things can go wrong when greed and unchecked risk-taking dominate, and how interconnected our global economy truly is. It shows that even the mightiest giants can fall, and when they do, the shockwaves can be felt by all of us. Thank you so much for watching. This is a complex topic, and we've just scratched the surface, but I hope this gave you a clearer understanding of what happened back in 2008. If you found this video interesting, please hit that like button and consider subscribing for more deep dives into the stories that shape our world. Let me know in the comments what you think or what other topics you'd like to see covered. Stay curious, and I'll see you in the next one.